The concerns that stem from what happened in Britain last week with the central bank having to jump in because some pension fund strategy caused a spike in yields. The central bank had to jump in and buy the gilts or buy debt, which reverses its tightening policy. But there are real concerns front and center. And there's an emergency Federal Reserve meeting today, right, Mitch? It's today.
It's today.
Today. But then you have Credit Suisse over the weekend. That stock's still down, I think, 6% this morning, but sent out talking points on Sunday for its bankers and relationship managers. Anytime you're trying to smooth people's feathers and ease worries about financial instability, whether it's within the investment bank or even outside, it makes matters worse. Mike, how do you see all of this right now?
Well, Dagen, since the first week of August, expectations for rates for Fed funds rates in February of 2023 have gone from 3.25 to 4.75. That's a massive move. And the Fed all along in this rate hiking cycle has been talking about a soft landing. And up until last week, this is their version of a soft landing. The sell-off in the markets, the sell-off in fixed income has largely been very orderly. We haven't had any flash crashes. We haven't had market pauses. And really, again, up until last week, nothing has broken. But when you go abroad and you start looking at these pension funds are very much centralized. So the UK pension fund is 2x their GDP. In some of the Nordic states, it's 4x their GDP because there are not multiple pension funds. There's one centralized ones. And when you have to buy a lot of long-term bonds to offset your asset liabilities, and rates spike this fast, you get these negatively convex situations, which is the fancy finance way of saying when things get bad, they go from bad to worse almost immediately. And so now with Credit Suisse, you're starting to see things break. And so as things are breaking, this is no longer their soft landing. So what are we going to see out of the Fed? The best I've heard is from Jeff Gundlach saying what the Fed should do going forward is not really be so focused on the rate hikes, but be more focused on the balance sheet runoff. You've already slowed the economy dramatically. Employment is a very much lagging indicator. We're going to get employment data on Friday. I think this NFP number is almost fundamentally broken post-COVID, or if it's not broken, it's very hard to compare the numbers we're getting now to things that we were getting in 2017, 18, 19, just because of the shifts in the labor force. I mean, we have very few more workers now than we did pre-COVID. So how is that possible to have an unemployment rate at 3.7% when you've had between 2.5 and 3 million people entered the workforce yet, and the number of unemployed persons is the same amount. So until we get some clarity from the Fed on when they're going to slow down or pause or pivot or what have you, I think markets are going to be ugly because now things are starting to break.
Before we go, Mitch, and Charlie Gasparino, I just saw a tweet that he put out, I think it was on Friday, how big investors are saying that the Fed is now more concerned about financial stability and risk in the system than inflation. And this is no knock on Charlie's reporting, but my reaction when I saw that was, of course, big investors are saying that because big investors want the Fed to stand by and be ready to bail them out again, as they have for much of the last 20 years. And you've seen it even in the market action last week that everybody is so quick to, or they have been, buy the dip, because the Federal Reserve is going to be there to prop them up if anything bad happens. And that seems to be the buy the dip mentality finally has been shaken a little bit. And that ultimately, maybe you get a downside washout sooner rather than later, which should be healthy.
You know, Dagen, I've been saying it all along, and Mike just made reference to it. Here's the reality. The Fed really started in earnest this past month trimming their balance sheet. They've been talking about it for a long time. So what do you have as a result? You have stocks falling and you have bonds falling simultaneously, and the falling bonds is the worst that it's really sort of ever been in modern history. If the Fed decides to Charlie's point, prop up the markets again, what are they going to do? They're either going to stop this tapering program, or they'll go in reverse and start buying back bonds again. That's the liquidity that they pump into the system that buoys stock prices and all asset class prices.
And Tom Philpson has pointed out, with a near $9 trillion balance sheet, it will take 4 years at the current rate to get the balance sheet back to pre-COVID levels. It would take 8 years to get it back to pre-financial crisis. So, again, the balance sheet never got reduced back to it was $800 billion before the 2008 financial crisis, and they took it to $9 trillion. And that bailed out leveraged rich people, period. And it screwed working men and women who just need a decent return, safe return on their investments. So again, when the Fed starts turning their back on the leveraged rich, man, they cry to the high heavens, don't they? Mike Lee, thank you so much for being here. Mitch Rochelle, stay right there. You're with us all morning long. Coming up.